Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin, the Beauty of Mathematics, part 55. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, as of February 1st, 2025, I guess technically I'm making it January 31st, but more or less February 1st, 2025, the total cryptocurrency market cap is 3.516 trillion, whereas the fair value logarithmic regression trend line is right around 3.405 trillion, according to a historic fit of prior data. This represents a very slight overvaluation of approximately 3.27%. Now, what this essentially means is that based on all of the history that we have, right, if you fit all this data that we previously have, you'll see that the asset class goes through periods of undervaluation and overvaluation. Now, the undervaluation phases can last years, just like the overvaluation phases can last years. And you can see that last cycle, we went durably overvalued in November of 2020, and we did not go back beneath the fair value logarithmic regression trend line until the summer of 2022. The cycle before that, we went durably overvalued in May of the post-halving year, right? So it'd be like 5 months, or I guess 4 months from now, almost just 3 months from now, because it's basically, I mean, it's February essentially. And it didn't go undervalued until near the end of 2018. And what I mean by durably overvalued is that sometimes you will see the asset class sort of go overvalued for a few weeks, only then sell off once again. You saw that over here in 2012, and then right there in later on in 2012. We saw it happen in 2019 and in 2020, where like it went overvalued for a little bit, but it didn't really stay up there like you saw in prior post-halving years, right? And then even this cycle, we've seen it go overvalued a few times, but so far it hasn't really been able to get that far off of the fair value logarithmic regression trend line. One of the reasons for that is because Bitcoin is essentially carrying the asset class, right? And we've talked a lot about that. If you look at the advanced decline index of the top 100 cryptocurrencies, it's been on a downtrend since 2021, right? Just to cover my bases and so you guys know what I'm talking about. The ADI has been on a downtrend since 2021, meaning there's been more assets generally declining than going up. But because the higher market cap things are going up, like Bitcoin, it can lift the entire asset class higher. So, in order to really go durably overvalued, you would likely need to see the altcoin market participate in a more than just being dragged up by Bitcoin. Because essentially, all that's really happened so far is there's been a rotation from altcoins to Bitcoin as Bitcoin has gone higher and Bitcoin dominance has gone higher. But one of the things to note that to get into a period of like this where you go overvalued, and not just a little bit overvalued, but significantly overvalued, and it stays like that for a long time, you would expect the altcoin market would need to participate. Normally, when you go up here, Bitcoin dominance starts to go down, right? It starts to go down. But because the Fed hasn't pivoted from quantitative tightening, or at least ended it, maybe that's what's keeping the asset class at bay. And it doesn't mean that Bitcoin hasn't been able to go higher. I mean, you can see that we've hit it a number of times in August 2022 and March 2024, and then again in 2025. The reason it continues to be right around the fair value is because, as I said before, the fair value is a monotonically increasing function, because it's just sort of assuming that as a function of time, adoption grows, more people get into crypto, therefore the fair value grows, and also, right, the money printing will never actually stop. So those people put those dollars somewhere. Where do they put them? So right now, there's obviously a lot of bulls and a lot of bears. Neither side's really getting what they want, right? It's not really going higher just yet, but we're also not seeing it break down beneath the fair value logarithmic regression trend line. Now, one of the interesting things about this is that if the asset class were to move at all significantly, then it would become either overvalued or undervalued. Right now, we've just been hugging that fair value logarithmic regression trend line. So let's suppose there's two outcomes, right? The asset class will go up or down. Obviously, sideways is one, but eventually we will have a decision. I think decision time is next week, okay? So if you're getting tired and you're wondering when is this sideways period going to end, if you just want volatility, you want to feel alive again in the markets, I think it's going to happen next week, right? After the labor market data releases, I think you're going to see it happen next week. Now, last year in February, we actually saw Bitcoin go up. So if you were to see another rally by Bitcoin in February and March, like last year, then you would likely see this start to really go more overvalued than just hugging that fair value logarithmic regression trend line. Unfortunately, there is no such thing as a free lunch, and there's no guarantee that we will see that move. You can sometimes sort of get drops back down to the lower logarithmic regression trend line, and that can serve as a catalyst to go more durably overvalued. That has happened before. It doesn't have to happen, but it has happened at least the last couple of cycles. So we will keep an eye on that. It did not happen though in all of the cycles. Okay, it did not happen in all of the cycles. So I think that the asset class is at a really interesting spot because there's also this discussion we talked about before as to whether you get a left translated cycle or a right translated cycle. Now, ideally, we get a right translated cycle where the cycle peak occurs in, say, later on this year, sometime later on this year. Every cycle peak has been in Q4 of the post-halving year. As you can see, the last three major peaks, Q4 of the post-halving year. There are such things as left translated cycles where the peak occurs a lot earlier on. In order for that to be a thing, you either need to see inflation really moving higher quickly or the unemployment rate moving higher quickly. Because we get the labor market data next week, I think we're going to see a reaction and we're going to figure out what is the most likely outcome after the releases next week. And maybe the inflation readings, say the following week, will help give us confirmation as to what ultimately the outcome's going to be. But if you take the percent difference between the total market cap and the fair value logarithmic regression trend line, you get a chart that looks like this, okay? So one of the things we've pointed out was like in 2017, when it went overvalued, it just stayed overvalued, okay? So last cycle, though, you can see that it tried a couple of times, wasn't able to, and then went very undervalued. The Fed turned on the printers, and then we got the move. If you go to two cycles before that one, you can see that there was a couple of moves here above the fair value, wasn't sustained, then it moved back down, and then it went up. This move back down happened in January of the post-halving year. This one was March of the halving year. 2017, it was off to the races in May of 2017. Now, a lot of people, I think, were hoping that alt season would just begin the minute that 2025 started. But you have to remember that in order to get it, I mean, I guess it's not necessarily proven, but you would expect that you would probably want to see looser policy to really get the animal spirits moving again. But in order to really get something like that, you need to see the asset class go more durably overvalued, where it really brings in that FOMO, and we're just not seeing that, right? We're not seeing that, at least not yet. It doesn't mean that it can't happen, it just hasn't happened yet. Now, the way I would think about it is if you do get a right translated cycle, like normal, then it would be the last year of the cycle at some point. It doesn't have to be immediately, but at some point, it would be in the last year of the cycle that all Bitcoin pairs start to go up. If we're just thinking like, how would it make sense to play out? I mean, the frothiest stuff usually goes up the most at the very end of the cycle, and then that's what usually leads into the midterm year bear market. We've seen that many, many times. In order to get that, though, right, in order to get that higher risk stuff, to get that move, I think, I could be wrong, right, but I think you would need to see the Fed end quantitative tightening. I think so. And it kind of all goes back to that chart that we've previously talked about, all Bitcoin pairs, right? Like total 3 minus USDT divided by Bitcoin. It all goes back to this. And sort of a reminder that last cycle, the Fed did not end quantitative tightening until all Bitcoin pairs hit their range low, right? If you overlay total assets held by the Federal Reserve, you'll see what I'm talking about. Right? That's actually when they ended quantitative tightening, was when all Bitcoin pairs hit the range low. Now, I'm just as surprised as you are at this point that it hasn't happened just yet. Doesn't mean it won't. You can see that the cycle before that, all Bitcoin pairs hit the range low as late as November of the post-halving year. And if this were to play out in a similar fashion, maybe you would just see it, bounce around in here, like kind of like it did last year, sort of bounce around for a while and then bleed to the range lows and then get a move up. That's actually what happened in the 2017 cycle. So a lot of people are looking at what happened last cycle and saying that's what's going to happen this cycle. But as you can see, it tends to track 2 cycles ago a little bit better than it did last cycle. And you can actually see that by looking at, something like the ROI from the cycle bottom. It actually looks a lot closer to, say, the 2016-2017 cycle at this point than it does last cycle. So there's some relevance to that idea. Now, if we're unfortunate and we get a left translated peak because the frothy stuff just comes up to the surface sooner than it really should, then there would be plenty of evidence for it by the third quarter of the year, right? The way it would work out would be there'd be a drop in Q1 at some point, and then sort of like a rally in Q2 that would put in sort of a macro lower high. Hopefully that doesn't happen, right? Hopefully that doesn't happen. But it's just something to keep in mind if Bitcoin's unable to make that move in February and March, like it did last year. And one of the things, remember, that we've talked about before is if you look at like the running 1-year ROI of Bitcoin, in order for it to sustain this running 1-year ROI of 2x, which is where it's been at since November of 2023, Bitcoin would need to start moving up in February. Because remember, last February, Bitcoin started to move up. So if Bitcoin does not move up this February, then this would start to decay, kind of like it did back over here in 2019, right? So it's important to keep an eye on that. Now, what is the market telling us right now? I would say right now, the main risk in the market is that, you do have sort of a slowly rising unemployment rate. As long as that's well behaved next week and it comes in 4.1, 4.2, the market's probably going to shrug it off and not really care. If it comes in high, like 4.3 or higher, that could be problematic in the short term because, as we've seen before, as the labor market loosens up, Bitcoin gets spooked if it starts to really go up. If it comes in a lot lower, you might think that's a good thing, but as we saw at one of the last releases, when it came in lower than the market was expecting, it actually led to the long end of the yield curve going up, which was sort of a headwind for risk assets. Now, when inflation data comes in good, or better than expected, it seems to be good for risk assets. We're kind of in this like regime right now where good inflation data is good for the market, but good labor market data, if it's better than expected, then it's been bad for the market because the long end yield curve goes up. So that's what I'm saying. If it just comes in line with expectations, it's neither really great nor bad. I don't think Bitcoin's going to care too much about it. If it's outside of those bounds, Bitcoin may start to care about it. I think that the biggest thing that sort of the thing that has my eye right now, and I'm curious how Bitcoin will react to this, is if you go to like year-to-date ROI of Bitcoin and you look at 2023 and 2024, they're almost a carbon copy of each other, right? Almost a carbon copy of each other. And if you look at Nvidia in 2023 and 2024, they're also a carbon copy of each other, right? Now, 2025, though, Nvidia hasn't been doing so great, right? The only reason I'm bringing it up is because within each asset class, there's a blue chip for that market cycle, right? Now, for Bitcoin, it's always been the blue chip. It's always number one, but obviously Nvidia over the last few years has been one of the big market leaders, and so it's relevant to pay attention to it. It's actually down right now. You guys know this is gonna hurt. I know it's gonna hurt me to say this, but you guys know how much time we spent on Bitcoin dominance the last few years. You guys remember? And how all these altcoins have been bleeding back to Bitcoin. And a lot of people that took the advice of Bitcoin heavy feel pretty good, right? And so do I. I mean, like, it was good to not just buy bleeding altcoins for 3 years and instead just stick with the kink. But in terms of blue chips within each asset class, this is a sobering reminder that you can make money outside of crypto. And one of the things to consider here is, how a lot of things have been bleeding to Bitcoin? This is a painful chart if you think about it. If you look at Bitcoin divided by Nvidia, look away, right? Look away if you don't want to see this. But Bitcoin divided by Nvidia. Since 2021, Bitcoin is down 82% against Nvidia. 82%. So maybe instead of talking about Bitcoin dominance, we should have been talking about Nvidia dominance, as crazy as it sounds. But this type of stuff is valid within each asset class, right? You have the blue chip, and everything bleeds to it during market conditions like we've been in for the last 2.5 years. So in this case, the point I'm trying to make is that the blue chip that's been leading the stock market in 2023 and 2024 is struggling right now. Now, obviously, a lot of it could be related to what's going on with DeepSeek and whatnot. But the other point is that you could make is that, well, there's always a narrative for anything. There's a narrative for anything. And it is important to recognize that last year at this time, when Bitcoin got that move up in February, Nvidia was going up already, right? It was going up. It was leading the way and showing that investors were ready for more risk. And then Bitcoin consolidated for January and then went up in February and March. This time we're seeing the opposite, right? Nvidia is going down and not up. So maybe it's a warning sign that something else is actually going on and that, perhaps we have to resolve some of these other macro things before this can start moving back up again. It is just something that's been on my mind recently with Nvidia sort of stalling out. Now, the good news is that Nvidia, while it does represent a large portion of the S&P 500, it's not all of it. And despite this drop, the S&P 500 has still managed to do pretty well, right? It still managed to do pretty well. In fact, it just closed the month at 6,040, which is the highest monthly close that the S&P has ever had, despite the fact that Nvidia has pulled back. If Nvidia continues to pull back in February, then it would likely be sort of a headwind for crypto. Normally, if crypto is going to go up, you're going to see the S&P go up. So keep an eye on that. That could be the risk. And the other thing to remember is that, sometimes when you get sort of a change in administration, if there's a lot of changes in the short term, that can lead to more uncertainty in the markets, and it can spook the markets in the short term. It doesn't mean that the whole thing is derailed. It just can spook the markets in the short term. So we haven't really seen that in the last several, election cycles. But if you go back to like 1981, when Reagan took office, obviously the markets got spooked for a little while. But again, the markets did eventually go up a lot. I mean, it's not like it was the end of it was still just sort of a higher low in a much larger macro bull market. And then if you go back to like, what was it, Nixon or some of these other presidents when they took office, like here's one in 1973, the market sold off for a while. In 1969, you can see it kind of spooked the markets. But I think the point here is to remember that in order to get a right translated cycle, which is what we all want, right? What needs to happen is the labor market needs to behave next week and inflation needs to behave. If all of that can happen and the stars align and we can still have this sort of in-between phase where the inflation data is not really accelerating and the unemployment rate data is not really accelerating, if we can get that, then it would more so favor going into that more durable overvaluation phase where the asset class goes more durably overvalued and we stay there for more than just a month or two. If, on the other hand, the macro data doesn't come in that great, then it could stall things up for one. I'm not saying the cycle would necessarily be over, right? But it could mean that the Fed has to pull more of their levers to get things moving again. Maybe lowering rates even more. It could be, QE, whatever it might be. But that's the way I think to think about the market right now. Okay, So what I would say is this: if we get a big move off of this fair value logarithmic regression trend line, then it would likely take us, relatively overvalued, meaning the asset class is getting kind of ahead of itself, and that'll lead into a market crash probably in 2026, like we normally get in midterm years. If the market gets a drop in the early part of the post-halving year, then I would sort of relate it to some of these other drops, like here in 2012, where it dropped off before then going up, or like in here, right, where it dropped off before going up. So that's what I would relate it to. But we'll see. We'll see what happens. And obviously, we've made these comparisons for a long time. And talking about right translated cycles and left translated cycles is more of an academic exercise. I'm sure at some point in our lives and our investing careers, we'll have multiple right translated cycles. We'll have multiple left translated cycles. It's not about, fearing one or hoping for one, whatever. It's just about trying to figure out what the market's going to do based on what it's telling us. At this point, it's still open, right? It's still open. And I still think it will depend on how the macro data evolves from here on out. So those are my views. These are, and all these views, despite how crazy everything has seemed over the last couple of years, despite everything, the asset class is still right at its fair value logarithmic regression trend line, right? And the good thing today is that, as compared to 2021, right, the fair value today is equivalent to the market cap of crypto. Back in 2021, right, 3 trillion was well above the fair value, because back then the fair value was only like 600 billion when it was at 3 trillion. Today, the fair value is at 3 trillion. So if it were to drop off, I think that'd be a good opportunity, right? Whereas back over here, we had to drop back down to a trillion just to get back to the fair value, or really 900 billion just to get back to the fair value. And ultimately it went a lot lower than that, right? Total market cap ended up going to like 800 billion or something. But you can kind of see how, as a function of time, the asset class grows, right? And so if later on this year, we're up here somewhere, and the asset class is getting really, really hot, and we're well overvalued, then just be prepared that there would likely be a bear market in the midterm year of 2026, just like we've seen in prior cycles. But anyways, guys, we're going to go ahead and wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Ultimately, I do think the asset class will go to 10 trillion, plus or minus a few trillion. And as we go to sleep at night, we cannot help but wonder, what's a few $1 trillion among friends?